Hi you guys, I'm Phil Town from Rule 1 Investing, and today I've really got a wonderful video for you guys. I want to give you some investing advice from Warren Buffett, the man himself. Warren Buffett's investing philosophies are central to Rule 1 Investing, foundational. Beyond just rule number 1, which is never lose money, his ideas all center around a very sober, thoughtful, and diligent approach to very low risk, very high return investing. First, Warren Buffett says, never invest in a business you cannot understand. The advice here is obvious, but it's often forgotten, particularly after investors have had some success. The temptation to believe that success in one area you know well allows you to easily analyze another area is much greater once you've had some good returns. But you've got to resist this with a vigor. You need to hold back that line, because really the critical key to investing is to make sure you don't step out of your circle of competence. Buffett himself has kept out of technology for a long, long time until just recently, given his lack of knowledge of the sector. Next, it is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. This quote's very interesting because it actually comes from Charlie Munger, who's Buffett's partner, and is instrumental, this quote, in changing Buffett's strategy back in the early 1960s, and probably is as much responsible for the incredible success of Berkshire Hathaway as anything else. So let's go back over that again one more time. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. All right, so this is really important. Very frequently, value investors will pass on anything they cannot get for a deeply discounted price. That's a big mistake, which is why Buffett has been asked many times if he's a value investor and said, yeah, not really, okay? Berkshire Hathaway has taken the completely opposite approach and instead is focused on investing in the best companies. This was one of Buffett's early lessons as a value investor, famously told as his turn away from cigar butt investing, which was the essence of Ben Graham's way to go about investing. Third, Buffett says, if you aren't thinking about owning a stock for 10 years, don't even think about owning it for 10 minutes. We call this the 10-10 rule in Rule 1 Investing. Investing is not trading. Investing is going out with certainty, knowing you're going to make money in the long run. Trading, we expect some losses. So investing is not trading, and it has a vastly different goal. Trading, when done well, is about taking measured risk for discrete periods of time at a kind of sufficient volume to generate profits. And by the way, it typically involves some pretty wild swings in profitability. When we lose money trading, it can be pretty big time. Investing is about minimizing risk to generate wealth over the long term. And when we say minimizing risk, Buffett's word for this are certainty. We want to be certain we're going to make money. Oftentimes when he's asked about why did he invest in this company or that one, he basically answers like this: because I think it'll be worth more in 10 years. So we're interested about the long term, not the short term profits. Another great Buffett quote in this vein: the stock market is designed to transfer money from the active to the patient. That's why we say over and over again that this basic style of investing that we do, what we call Rule 1 Investing, is simply laziness bordering on sloth. And here's another great quote from Buffett about the stock market. Remember that the stock market is manic depressive. He talks about the stock market as Mr. Market, this manic depressive character who some days is like extremely euphoric and some days is incredibly depressed. For any consumer of daily financial news, this will ring true. Equity markets bounce around from day to day on the smallest kind of news, like whoever's the most emotional seller or buyer. They rally and crash on emotions and sentiment, and they celebrate or vilify some of the most inane data points. I mean, watching CNBC is hilarious. It's important not to get caught up in the madness. It's very important you stick to your homework. And here's the critical word: always stay rational. It's not supposed to be easy. Anyone who finds it easy is stupid. This quote is actually from Buffett's longtime partner, Charlie Munger, but it really does say it all. Buffett himself has made basically the same point, that you don't have to be a genius to be a good investor, but there is a lot of hard work and there's due diligence involved. In fact, what Charlie Munger says is it's really simple. He basically talks about it like if they were teaching this in college, the professor would say, 1 hour's worth of stuff, and then what do we have to do for the rest of the semester, because it's all out there. But simple is not easy. There is work to do. And so what we do when we learn to invest is to narrow down the work to the critical kinds of things we have to do, and doing things, simple things, like just coattailing great investors can save you an enormous amount of work. Sixth, price is what you pay, value is what you get. This is one of my favorite things that Buffett ever said. In other words, you don't focus on short-term swings in price. You focus instead on the underlying value of the investment. So if you want to think about what that means, is imagine you go buy a beautiful brand new Porsche, and what you get is the Porsche. And what you paid could have a huge variation, right? You could pay $50,000 too much. You might get it for $50,000 off if you have some kind of special deal. This dealership has to go out of business or whatever. What you got was the value. You got the Porsche. What you paid could be all over the map. And the same thing is true in the stock market. Beware the investment activity that produces applause. The great moves are usually greeted by yawns. Now, from a man who has made a fortune on companies like Apple, American Express, General Motors, UPS, Johnson & Johnson, MasterCard, Walmart, this is sage advice. This is not like, woo, Tesla, you're back in the great battery and the great this and the great new that. And no, great investing is usually about buying something boring that's very, very likely to continue doing what it's done in the past all the way out for many, many years in the future. I got to tell you, this is really sage advice. Hope that all your investing is low risk and boring. Next, we eat our own cooking. Certainly, you should never invest in a transaction where management incentives are not properly aligned with your own. If they make money, you should be making money. This does not happen all the time on Wall Street. Be very careful if the guys who are running this company are not eating the same food you are. Ninth, Wall Street is the only place that people ride to in a Rolls Royce to get advice from those who take the subway. This is a great quote. It's so true. You realize your average financial advisor is just a guy slaving away, trying to make a living to get his kids through college. In other words, just be careful who you trust, okay? Much financial advice is offered by equity analysts, by a range of advisors, and in the media should be taken with a grain of salt. Absolutely true. Buffett and Charlie have long worked with the same people with whom they have long histories of trust and experience, and any good investor should do the same. Lastly, we use debt sparingly, and when we do borrow, we attempt to structure our loans on a long-term fixed rate basis. What Buffett's talking about here really warns against over-leveraging your investments. The truth of the matter is, it's over-leveraging your investments by borrowing money to invest and also buying over-leveraged companies. So whether it's too much personal debt that you have, you're too over-leveraged, or you're investing in a company whose return depend on borrowing a lot of debt, too much or too costly debt can destroy your track record. I know this from firsthand experience, and it's very painful to watch a management team take advantage of the debt they've got in the company to completely wipe out the shareholders. I try to steer away from companies with debt. Now, I'd love to hear from you guys. What is your favorite piece of investing advice, whether it be from Warren Buffett or anybody else? Let's hear it and let's talk about it. Leave a comment below with your answer and I'll be sure to follow up with you. And I really want to tell you, thanks for watching. Now go play. If you enjoyed this video and you feel it was valuable in teaching you more about Warren Buffett style investing, subscribe to my channel and share this video with your friends or anybody else who might benefit from this information.